Good morning, everybody. Welcome to the Flow Show, the day after the night before. No Stelios with us this morning, me and the K-Meister to guide your hand. How you doing, Kay?
Hey, good morning, Ryan. Good morning, everybody. Yeah, I'm doing well, mate. Doing well. Ready
Good stuff.
Ready for the next biggest ever day in our life?
No, we've had that. The football fixtures were out this morning.
Yeah, okie dokie.
But yeah, on to the next one, as we say. And we're gonna have a little look at part and parcel of the headlines coming out. I'm going to try and show you what tightening financial conditions actually look like on the ground floor, just to get an idea when these central bankers go on about it, what it actually means, how it comes about, and what it does for central bank policy, or potentially does for central bank policy. So we'll crack on with the headlines first. And China, as expected, cut its rate by 10 pips on the medium-term lending facility, the MLF, the one-year MLF, cut the rate to 2.65% from 2.75%. They've been cutting rates all week, and this one was expected as well, so no real surprise there from those guys. On the data front, we have had some Chinese data out as well overnight. Excuse me. Industrial production numbers, retail sales numbers, unemployment numbers there, unemployment unchanged. Retail sales, despite the fact that things apparently are not looking too good in China, retail sales are still healthy, 12.7%, missing expectations, but there'd be countries around the world who would give their right hand for numbers that big. Year-to-date numbers were up at 9.29%. So potentially reflecting a bounce, a COVID bounce, let's call it that. Industrial production numbers missed expectations at 3.5%, but still a decent positive number there, even if it's a little bit less than the month before. House prices, talking about the much maligned property market in China, they were up 0.1% year on year, following a minus 0.2% prior. So not exactly bubbly, but not going down anymore either. China's Stats Bureau says the consumption recovery faces some hurdles, and they will support consumption growth. So for now, they're going to keep on the easing path, as we've mentioned. They are worried about weakness over there. Over in Japan, we've obviously had a big move up in the yen overnight, or yen pairs overnight. Dollar yen ramping up through 141 without seemingly blinking, and well up to the highs around 141, 40s, 50s. Bit of a surprise move, perhaps. Was expecting some sort of move after the Fed yesterday, but that one quite surprised me when I woke up and saw it this morning. We've had some of the wafflers coming out about those moves. Chief Cabinet Secretary Matsuno saying excessive movements in Forex markets are not desirable. There's no change in the stance that we will take appropriate action. So the usual jaw boning there. Just to do the usual warning, they don't tend to get really worried about FX moves unless we're moving big percentages a day, i.e. 300 pips in a session in a day. Those are the sort of moves that got them coming out of the woodwork for intervention last time. So, 120 pips, 150 pips over the course of yesterday to today, not quite in their territory. If we do another 200 pips a day, then perhaps maybe we're edging towards stronger intervention talk, but it's going to take a lot of volatility before they actually pull the trigger on this. And just to remind all you folks, in case you don't know, it's not the Bank of Japan that decides on intervention, it's the Ministry of Finance. So it's those guys we need to pay attention to. One thing I would say, though, we haven't really heard from Urida his thoughts on yen moves and stuff, Kay. Is that something we should perhaps be on watch for, like we knew what Garuda used to say? We don't know what his thoughts are, do we?
I think they've already started their meeting as well, so I don't think that they are allowed to talk to or give any comments, but perhaps Urida may may have this freedom to do so. And the thing I note is you are on the 15 minutes there. Look when dollar yen took off. It's and look at the date. It's a Gotobi day today, and I reckon there's been a lot going on there as well. It took it up 60, 70 pips into the Gotobi, and then it never looked back. That has to do, but then I also think it's just a case of front-running the BOJ, roughly the same thing that I've been doing with my sterling yen and my dollar yen options. And then tomorrow we'll see. Since they will have decided what they want to do before our next close show, perhaps we can take a quick look. The base case is really for them not to do anything, but and again, we've been talking about that enough by now. My base case is still that they will in some form normalize this year, but it's probably going to be slower than anywhere else. But they may start to talk about how they look at things. So there is an element of there, or there could be at least an element of surprise possible in this meeting as well, depending on how actively they discuss about their plans to come, and that may see the market move a little bit. I think when we will see the results on the Bank of Japan. If they don't do anything, then there has been a legion of articles actually over the past weeks saying that the red line for the MOF would be 145 in dollar yen. Now, why do they put 145? We know that the first interventions by were around 146, right? The shy ones before we rallied up to 150. Why people would say 145? I'm not really sure, but we know that when we started to really dive lower, that was from around 145.6. You know, when and I think it's on one big CPI data out of the US, if I recall well. So perhaps the market is looking at that zone for them to get nervous. And by then, it may have been accompanied by another 200-300 points. Remember, Kuroda saying that 200-300 points in a day are too volatile. So that means yesterday's low was 139.30. I'm not sure that they look at the low, but by the time we'll be at 142, if we get there, that may be considered as perhaps a little volatile. There's a lot to go to do as well in the 142s there. So yeah, that a little bit running forward on the Bank of Japan. So it should, in theory, for the markets right now, be plain sailing, but we cannot completely rule out some kind of chatter about what they will be planning to do. And we should get it, although close watchers to the Bank of Japan saying that they should act as a surprise, but Ueda does not seem to be that kind of guy. He has been an over-communicator since he started, so I'm not sure that he's the one that will surprise markets like Kuroda did a couple of times over his tenure.
No, agreed, and we've been highlighting that all the way through. He started off talking the same lines, then he went what could be considered a little bit hawkish, changing just some minute language. They talk about a change from persistently easing to patiently easing. Doesn't sound like much, but I think that's the sort of thing perhaps we're going to be looking out for at this meeting. Just some subtle language changes that just takes us half an inch closer towards easing this, but without giving the game away and upsetting everyone. Yeah. But we've been saying that the door's been closing on the time that they can do something with policy, and it just continues to close very slowly. Like you say, they're gonna.
They could have a real trump card in hands if we assume that the Fed is perhaps close to be done. Well, likely close, much closer at least to be done. And the ECB, I don't know for how much longer Lagarde will be hawkish. because I still think it's against her own nature, but she had to. They could have actually a trump card and send the yen much higher if they start to hike when all the rest is done, and even looking perhaps at the other side. Even though I don't think, and we really have to price out, I think, expectations for any rate cuts by the major central banks this year, right? So they will still
Yeah.
be hiking when the others are very high, but they may have some decent effects if it's done when the others are completely done. Now, Ali was asking, since we're on the yen, will the sterling yen, where will sterling yen pull back? Next resistance, yeah, it's it's around 180. It depends. It's around 180 and a half, 182. Okay, for the sterling yen, and that's roughly my targets. If we see 180 and a half or so, I'm going to be a very happy camper. Post Bank of Japan, the market doesn't go really one way, and we have to take into account that if it goes fast, and Matsuno already hinted at something, and they see not only dollar yen, but they see the rest of the yen pairs ramping higher as well. If you look at euro again, 153 we are. It's pretty lofty already. So yeah, 180, 182 and a half.
Yeah, it's all Rip City as far as yen pairs go. And like you say, most economists are painting a number at 145 as to when Japan will step in. But like you say, they've never put a number on anything. It's all about the volatility and in how high that those pairs go. Right, so on to the US. We'll look at just quickly show you the PPI data from yesterday as well. Didn't really add much to the conversation, more just reiterated what we saw from the CPI numbers really. PPI year on year coming down to 1.1% from 2.3 prior, bit lower than expected. Core numbers as well doing similar, down at 2.8%. They're a little bit under what was expected. So nothing really shocking there. These are still gains. We have to remember that these are still higher than the year before. So until we start seeing negative numbers, the likes of which we're starting to see in some European countries and elsewhere, these are still gains. That still keeps inflation in the pipeline. And over to the Fed and yesterday's FOMC and what Powell had to say for himself. Well, we got the pause as expected. But as expected, it came along with a strong higher for longer message, not letting the doves get their foot in the door. What they did was the dots all got shifted up, the median levels. So we saw, as you can see there, so these are the interest rate projections. So for the rest of the year, for current year, which is 2023, that got hiked to 5.6% from 5.1%. For the next year, up 3 pips to 4.6%. For 2025, up 3 pips also to 3.4%. The only thing that stayed unchanged was the longer term projection at 2.5%. Now this could be fairly important because it's almost them penciling in what they see as a neutral rate once rate hikes are done and once rates return to normal, whatever they call normal, the neutral rate. This is still the rough market for where the central bank sees its neutral rate coming back to. So the higher the rates go, the more they'll have to cut back to that level. But that was a big lift in the 2023 rate predictions, 5.6%. That was the hawkish tilt to proceedings. Now, Powell had plenty of comments, as you can expect. He said the full effects of tightening are yet to be felt. Nearly all policymakers view some further hikes this year as appropriate. The main issue is determining the extent of additional tightening. Also talked about the Treasury refilling the TGA in its coffers and what impact that might have on reserves. And he says he doesn't think reserves will become scarce over the course of the year. Doesn't see them becoming scarce in the near term, and that we are starting at a high level of reserves. Now, the cut conversation came up as well, and he said no policymakers see cuts this year. and we are talking a couple of years out for rate cuts. So as expected, he came in with a what could be construed as a dovish pause, but wanted to maintain that hikes were still on the table, still possible, and that rates indeed may be going up this year and staying higher for longer across the other years. He did have a little blip when he was talking. He mentioned the word skip in answer to a question that the Fed was skipping, and then said, "Oh, we shouldn't call June a pause a skip. That's the wrong thing to say." So the market got a little bit jumpy on that, thinking it nailed on a July hike, because obviously a skip means you're missing one to do the other one, rather than a pause, which is you pause in and then you may decide at some later point. So the market had a little bit of fun and games on that one. So then, what do you reckon, Kay? Pretty much as expected, I should think.
Yes, pretty much as we expected. And then I found him having a hard time to go either side of the needle. He was trying very hard to be neutral, to a little hawkish, but yeah, I don't think the market got a very clear message out of it either. He said at one stage, because if you say skip, that means the next one you will hike again. But he said if skip is the wrong word, so pause should be the better word. But pause could be a longer time than a skip, so to speak, right? And he had a hard time afterwards, I think, or even during his whole press conference. Even when reading out the statement, he was like, yeah, the housing market is showing weakness. Some stuff is showing weakness, but the labor market is still good. He had I think yesterday was a pretty strange meeting. Me at least, for me at least, and I know I'm a little long. Well, I'm not less now, but I was a little long dollars, and mainly via options in dollar yen, and for this afternoon on Lagarde as well. But I find it a strange meeting. I'm not going to buy as such dollars on the back of this meeting, because he doesn't know, and I've said that before as well. I think the central bankers now do not know, and that's the definition of data dependence, of course, do not know what they are going to vote for in the next meeting, because he also said that but the dot plots are not really something to hang on to, because we don't know what's going to happen at the end of 2024, 2025, let alone next year. So he's really leaving everything open right now, but I've got the impression that for him we are close to the end of the road here. But they will want to keep yields high for longer. That is already priced in. Well, already priced in. The market has priced in a fair bit of it, because we see the short to medium term rates staying relatively high, although we do not break higher. But yeah, it's a bit of a tough meeting here to initiate any position, I would say. I think the market now has already turned its attention to the ECB. If you look at the crosses and things, it's a flip the coin meeting. In 2 words, we are data dependent just as much as the central banks are now.
Yeah, I mean, it was a surprise. It was a surprising one aspect to me. You know, if you think you're going to hike in a month's time, why not hike now? You know, a hike now is going to take much longer than a month to filter through to the economy and everything. And I just couldn't see the Fed getting into a situation like the BOC or the RBA, where, you know, okay, they're going to hike and then they might pause and they might hike again. It's the credibility thing again for me. But you're right what you say, they're data dependent, so they have to react to the data. They've got the data going the right way. It's all lines up for a pause. But is it a pause and is it a skip? And that's going to jiggle markets around, most definitely. One thing else from the Fed is that they're going to release the results of their bank stress tests on June the 28th. That might be something to keep an eye on because of all the banking stuff going on in the US. We get to hear the health of banks and whether there's any problems, which pretty much we would have heard about anyway, but just keep an eye on that one in case there's some wholesale changes that banks have to go through to get on the right side of that report. Now over to the UK, and this is one I'm going to talk about with financial conditions. Okay, so there was Reuters poll expects all 64 economists all expect the BOE to lift the rate by 25 pips next week to 4.75%, and they see the rate peaking at 5% in Q3. That's the same as the last poll. So as far as that's concerned, everyone's nailed on for a hike next week. Now, that rate, 4.75%, that's next week. HSBC are raising mortgage rates for the second time in under a week. Why are they raising mortgage rates? Well, I'll show you this. This is the 2-year swap rate in the UK, and this is what a lot of our mortgages are based on. Now, for those who are not from the UK, I'll tell you how it works over here with mortgages. You can get a mortgage for 10, 15, 20, 25 years, okay? But what happens is you usually get a preferential rate for the first 1 up to 5 years. So you may get a discounted rate for a 2-3 year period. After that period, you move on to the standard variable rate. So that's usually at a discount. That's different to somewhere like the US, where you'll get a 30-year rate, 25-year, 20-year, whatever, and that rate is fixed for that period, unless you go on a variable rate. So the difference here is these 2-year swaps in the space of a month have gone up pretty much 100 basis points. Okay, so they're already at 4.7% last month. This is before the Bank of England expected to raise actual rates to 4.75%. So we're up at near the 5.7% mark at the moment. That's what's causing an uplift in UK mortgage rates. As you can see there, this is a 2-year swap, so rough basis on how mortgages are priced. Now, showing you the difference between financial conditions, if a lot of the UK people are on 2-year fixed rates, so they get to the end of their period, they can remortgage into another better rate. That's fine when you're coming through 2011, all this period before here, because you can remortgage in and out of a bit of a better rate. You're not going to be that far off. Even if you come in to offer your fixed rate discount onto a variable rate, it's still not going to be hurting you too much. It's going to be a percent and a half above what you were paying. However, when you've got all people coming off 2-year, 3-year fixed rates, and now you're into here, you're going to get a huge jump. Give an example. I've got a small mortgage. I fixed my mortgage just before this kicked off, pretty much when I started saying that inflation is going to be coming. I got locked in at 1.59%. Now, if I wanted to remortgage, I'm looking at maybe 5.5%, near 6% to get a new mortgage. There's going to be a lot of people in the UK who are going to be coming out of fixed terms, and they're going to be 4 or 5% higher on their interest rate. This is tightening financial conditions. This is putting a big squeeze on people's pockets. And this is just the mortgage world. Forget talking about loans, credit cards, that sort of thing, whose rates are also going to be going much higher. You compare that to the US, where you look at and this is just an effective rate, the MBA. So over the past 20 years, rates have been, fairly solid, 4, 5%, 6%, you could say. So even people remortgaging here are remortgaging around the same levels, or we're only talking a couple of percent difference. That's a completely different situation to this, as mentioned, where people are coming from low rates around 1 to 2% and getting walloped into 5%. This is what banks are looking at when they talk about financial conditions. This is what the Bank of England is looking at. Bank of England rate is currently 4.5%, expected to go to 4.75%. However, the market is seeing much higher. It's seeing much higher rates, and it's already crunching consumers over it. What does that do for rates? Well, it potentially means that the bank needs to take a look at whether raising rates is actually the right thing to do, because are they going to add to this problem? They keep raising this level, this rate, swaps and things like that, mortgage rates are going to keep going higher because you've got to add on the premium between the bank rate and what the banks are going to charge. So if the bank has to hike to 5% for inflation, you're going to be seeing rates 6-7% for mortgages, much higher for borrowing in the UK. And that's the point that the banks need to look at. That's the important part, because that's where the economy starts faltering. Because if people are paying more for debt, they're not spending on retail sales and things like that. Discretionary spending goes out the window. Money's tight, wages are tight. That's when you get a slowdown in an economy. And that's why the BOE are going to be reluctant hikers. Bailey's already said he doesn't want to be hiking anymore. But he may have his hand forced if inflation continues to rise. It shows the rock and the hard place these central banks in, particularly the Bank of England. What do you reckon, Kay? It's for the BOE next week, just to get a little bit of ahead. How can he get out this hole? He can't really, can he?
Sorry?
How can Bailey get out this hole of not wanting to hike?
He's put himself in a disastrous position since he came on. Really, I mean, we've been saying it since the start. I mean, even without hammering on him personally, because we don't do that. But the fact you put a regulator in charge of a bank, of a central bank, when things turn sour in the markets, I mean, somewhere, what can you expect, right? He will be forced next week, right? They have to go. I mean, if you look at the data, if you look at the inflation, they probably will be forced to go. Now, the sterling has enjoyed all of it, and I think it was supported by fundamentals as well. But next week, I'm going to be a bit cautious for the viability of the move, because we know that Bailey has the power to kill the sterling at whatever level or whatever demand there is in the market. So we are going to have to be a bit careful. Abir, no, I don't think it's well, I mean, technically it may be a level to sell cable here, but I would say that sterling is still going to remain in demand unless we get I haven't looked at the calendar. Do we have any more important data out of the UK before?
Yeah, we got CPI the day before the Bank of England.
Sorry, mate?
We've got CPI the day before the BOE.
Yeah, so I reckon that as a currency, sterling is still going to remain okay until that CPI number. That's my base case anyway. So I'm not yet looking at selling sterling right now. Could be once CPI comes out, or once we get the Bank of England. And I'm going to be neutral into that next week. Sorry. No, but for the rest, they will be forced, right? I mean, they can't do anything else unless we get a 1 or 2% drop all of a sudden the day before the Bank of England. For now they have to go.
Yeah. Okay. And just to quickly answer Abir asking about what's happened to gilts. Well, we can see what happened in September. Let's go back there. There was the spike there. Looking at the 2-year, they're not exploding out. I won't go into the whys and wherefores of this. It's not as the press make out. There was a specific issue that caused those yields to rally. It was nothing to do with budgets and politics and all that sort of waffle. It was just part of the pension market getting caught out with rate hikes, trying to leverage up all the low rates. But
September was the Kwarteng Trust.
Yeah, that got the blame for what happened, but it was nothing to do with that.
On the day they announced it, so
yeah, but it's a smokescreen. The problem was that the pension companies, that's what caused the rally up in all those rates, because rates were going up and the pension companies were all leveraged because they were having to deal with low rates, and they had to get bailed out by the Bank of England. Nothing to do with budget stuff. It was just, as I say, smokescreen. But anyway, that's old news. But yields in general are all up in the UK. Well, sorry, I was on the wrong one there. So there's the 2-year, and we're above those September highs, and nothing to do with budgets, what not, or wherefore. Everything to do with interest rates, inflation, and the likes. Right, so quickly on to the ECB, because no Kay's shooting off in a moment. What's expected from Her Majesty Queen Suntan? Another hike is expected, a nod towards perhaps one more, maybe two more. I think we get a bit of a message that they're going to hike this month, obviously, and that another one's on the table. Then we might get a bit of cloudiness around future hikes. It'll be a bit of a shock for me if she announces a pause after this one, because again, the ECB do not want to let financial conditions weaken. So they don't want to let the pivoters get their foot in the door, because then they undo the work of hikes. It's the opposite of what I was showing you from the UK. If the market expects rates to come down or rates to have peaked, then they bring down things like swap rates and expectations for the height of rates, and the ECB lose the higher for longer element, and then they're getting easing coming into their bias. So I expect Lagarde to maintain the higher for longer, a bit like Powell. So maybe indicate they're close to coming into restrictive territory, but not ready to let go and declare a full-on pause just yet. What month are we in? Are we getting forecast, for this one, Kay? Or do we get those? Sorry, mate.
Question. Let me quickly go on to the
check that one, whether we're getting an updated forecast. June, I think we might do, because it's half year, but we'll let you know on that one. So that'll be needed to keep watch as well if we do get those forecasts, just where they think inflation's going and the economy in general. For the euro, we're in one of these situations where it's felt like it's wanted to go higher all week. And it just seems to be held back at the moment. It was held back a bit by the Fed. We're over that hump, held back by the CPI. We're over that hump. So we've come through all this stuff and we're still relatively well bid. It could be a case that the market is just waiting for confirmation from Lagarde that they are going to hike and continue to hike, and there's no signs of easing, at least. And maybe we're going to have a crack at the 109s, get up through this zone, 108.70s, and have a look a bit higher. I still potentially favour a dip buy on this, purely because we know what the Fed are doing now. They're on pause, so it's really about who else is carrying on hiking. I'm still keeping an eye on euro sterling. It's still holding this 85.40 area, and it's going to need something less hawkish, I think, to get me down to 85s for a trade down there. But otherwise, I'm going to be looking for maybe a decent rally in this one, maybe getting some shorts to run into the Bank of England next week. But it's not giving up much on this for the moment. Kay, do you want to have a quick look around before you hop?
And before I do that, I don't see the details of what they expected. Just like monetary policy decision, it's not as clear as on the Fed. Yeah. So
let me stop sharing.
Just quickly, because in like 5-10 minutes max, I need to.
Yeah, I know you got to shoot, mate.
Yeah. Euro dollar. So first of all, my opinion, and so I'm slightly in a contrarian mood here. I think personally, but I may be a meeting too early. I think personally this is the last hawkish meeting potentially for Lagarde, for her, because I think that psychologically. She has been forced to get into the hawks territory because inflation showed it. Inflation is still stubborn in the EU, but we have seen some of those data start to come off and by full percentage points, right? So my personal opinion and view on Lagarde is that she will not remain hawkish for longer than she really needs. So there is a little bit of a risk for the euro, perhaps, on her during her presser. I agree with Ryan. There's no need to change. There's no for the statement. That's going to be pretty straightforward. The market may actually buy some more euros. I don't know. And we could actually go into this 108.90, 95 zone, providing we break above this what is it? Yesterday's high around 108.60, 65. Then there's going to be that's going to be an interesting one. This one, it's the 61.8 is around 109.20. I think that's going to be an interesting level for the euro to watch. As we've seen yesterday on the after the Fed, we still find very decent support. And although I think it has to do with the okay, we are getting the new forecast. That's interesting. There's still very good demand here around 108. So I think that is the marker for tonight on the close. Whether you're above or below 108 is going to be important enough for the market to view it, at least in the short term, may view the direction. So if we close below, then I guess we are going to retest those low 107s. If you stay above, though, it may mean a bit more, then we should be going and testing here. If they're really hawkish and really brush all those weaker data that we saw over the past weeks, other than inflation, then perhaps the market is really going to take it and take the euro higher. One of course that is that we need to keep a very close eye on is this euro yen, right? Euro yen is really rocketing together with the rest of the yen crosses, but there's a part of ECB in there as well. So keep an eye on what's going to happen anywhere between 153.65 and 154.25 over the ECB and combined Bank of Japan, because the upward trend resistance lies up there. I don't know what I thought I had something on the weeklies over there as well. That's not, yeah. You see, it's the 78.6 of the whole move lower, and that's long term, right? From that's the big move down that we saw over the global financial crisis and the European crisis combined. That's around 153.60. We're really not that far, okay? So I think this whole zone here is going to be quite important. If you get back to closer, if ever there would be a big disappointment, it's one that I don't like to trade before I know what happens with the Bank of Japan as well. But I think we need to for this one to continue to go higher. First of all, we are going off. That's quite low. We're going to have to hold this prior high here around 150.160, 151.40.60. That's the support zone for me. The first one on the euro yen. But again, trading euro yen is a big speculation right now. I know we are traders. We speculate. We like to speculate, but this is not really one that I'm going to trade heavily. Same thing on the euros. The euro sterling in turn, I'd love to see some more topside here. And I mean, ideally, if ECB takes it into the 86 zone, 86, you see, there's some good resistance here now, 86, 86, 20, 25. We take it up in this zone. If Lagarde or the statement takes it up in this zone, I may be tempted. I may be tempted to counter trade that one, because I do think that sterling will remain supported at least until that CPI data number next week. So that for the euro sterling, we have to look quickly. Yeah, I really need to shoot in a bit. We have to look quickly at sterling yen. Sterling yen, there's two levels that are going to be important here. So the first one is this weekly 78.6, which lies just above 180.75. There is also 180.25, 30 is also a spike low before we bounced and then took the big dive. So if ever this goes into the 180s, I'm going to be a happy profit taker on the rest that I have running right now. And it's also we also have some extension activity there. Some people are looking at what's happening here. Some people are looking for the 161. So we could push through into the 182s, but be careful though with the yen after the Bank of Japan. If it would be explosive, this dollar yen, and all the yen crosses, MOF may be tempted to come out with some stern warnings and may scare the market a little bit. On the downside now, I've raised my stops here to just below this trend line right now, around 176.5. I think 76, 40, 50, and 76, 60 should be a bit of a support zone now. And Ryan, I have to give it back to you because I need to go.
Yeah, go, mate. Go.
Thank you, everybody. Have a good day. Trade safely.
Cool. Thanks, Kate. And we shall speak to him later. No doubt he'll be back for face, I think, and definitely back tomorrow. So let me grab the screen back. Hopefully that works. Can you just give me a yes in the chat to make sure you can see my screen, just in case I'm having any little problems? Cool. Thank you, Brian. Yeah, so just to crack on with what Kay was saying, we looked at the euro, and yeah, I think it's all looking well bid. The dollar's looking off, and I said yesterday here and on Face that I see no real reason why the dollar would strengthen significantly. Dollar yen isn't a dollar move, it's a yen move, okay? Because you can see that by all the other yen pairs. You can see that while cable is still holding up, euro still holding up, Aussie still holding up. So it's all a yen move. So again, you've got to look at the balance of risks. You know, what is going to send the euro meaningfully lower? That's going to be the ECB coming out less hawkish or dovish. On balance, is that going to happen? No. So we could be waiting here just to get confirmation, as I say, from the ECB that they're not going to do anything dovish. If we get that, we could well be flying high after. So don't get sucked into thinking we've got resistance here, we can't break through, you know, 50s, 70s, and therefore we're going to be heading all the way down to, you know, 107 or more. This could just be waiting for getting over the hump, and then the market's going to come back in and take it much higher. I wouldn't be surprised if we're trading, you know, if we've had a look at 109 by the time we're over the ECB. And from that, you know, we could look at the crosses, what's going on in pairs like EuroCAD. You know, we've got this big number up here, 146.50. Our old mates, we've been watching that for many, many months. We haven't quite got down. This is an area I was looking at previously. Again, it's a lot of the other guys trade it more actively than I do, but we had this level down at this 38.2 fib, 42.50s, and you know, maybe down to the 30s. Couldn't quite get down there, and we're holding up now. So we have got some levels on the euro. A bounce brings us up to 45 perhaps, and this former support and resistance area again, would love a move up there, but I'm not sure we're going to get it. Now, do I think the euro is going to rally massively on the back of the ECB? No, because they're potentially coming to the end of their hike cycle, be it one hike, two hikes, or three hikes. So the market knows there's not a lot left in the tank, but we're playing divergence in reverse now. If the Fed are on pause, the ECB are doing a bit of catch up. When they pause, there's going to be an interest rate gap between the two countries. That's going to be traded very significantly. And then we move to the next phase. This pause, are the hikes going to continue, or more likely the market is then going to start ramping up cut bets when central banks are going to have to get back to neutral. This is all going to happen over the next few months. So, you know, even with the ECB still hiking, I'm not expecting to see new highs in a lot of euro pairs. It's going to be trading between what we already know and what's expected further down the line. Dollar China is another one. I was waiting for a dip on this one over the CPI. I was waiting for a dip over the Fed, not getting a dip whatsoever. Dips are very shallow at the moment. We can't even really get down. Well, we got down to 115 yesterday, and I didn't go there. I still want to be long. I just have I have an aversion of buying up near tops. It just doesn't compute in my trading brain, just the way I assign my risk. But the more it stays up here, if we do get a move down to 711, 712, where I'd like to get in, it's likely something's changed. So I may not be as keen to get in there, but I'm getting a bit FOMO, so I may have just to bite the bullet on this one and jump in and see what happens. But again, this move down off the highs is purely yen led. So this will be CNH JPY, which I will show you quickly. So this is why you need to know what is the driver for all particular pairs. You know, the yen is really driving a lot of stuff here at the moment. So that's driven CNH higher with yen weakness, which has obviously helped USD CNH go lower. It's the same for all the crosses. This is the driver at the moment, the yen. It's all about the yen. This is why I explained in the chat room, you need to look around at the crosses to know which horse is pulling which car. So it's not the dollar is being stronger despite what dollar yen's doing. It's the fact that the yen is weaker all around the grounds. If you guys and girls have got any requests, throw it in there. We'll have a look at it. Yeah, that area is big, Gavin. Very, very big down there. I don't want to look at Euro knock. I hate it every time I look at that one. Where are we now? Still knocking around 1150s. So, you know, we've got a bit of a pivot line coming in now around that, call it 1147.48. We seem to be finding support against it, resistance underneath it at times. So that's a bit of a marker there for what happens with the ECB. Look at where we close after the ECB. And again, look at the week as a whole where we close. If we're closing in something like dollar yen above 141, it's going to look fairly bullish. If we're under 141, then maybe we're setting up a bit of a top there. Same for the euro, same for cable. You know, if we can't get above 127, that's the latest high, and this one likes to be playing with the big figures at the moment. If we're below there, below 126 on a close, it keeps us perhaps in this bit of a consolidation phase, although it is a pretty wide range on that one. Yes. Let's have a look. Anyone else got anyone else? Mike, you're in combo with euro and sterling. Good for that one. Hope you're looking at some levels in that one. Right, unless you guys and girls got anything else to look for, we'll call that a day for today. I'm set up for my trades for the ECB, as mentioned. Want a decent rally in the euro sterling to hit to run into the Bank of England next week and that data. So that's going to be my pair of choice, I think, going into the ECB. If you've got nothing else, have a wonderful day. Don't forget to put the coffee on when you're listening to Lagarde waffling on later, trying to stay awake. Trade safe, make lots of pips, and we'll see you all again with a full team, hopefully, touch wood, tomorrow. Thank you very much.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.